afternoon and welcome back, everyone. And I'm pleased to have this conversation with the panel. And I was thinking that maybe we should start with how you all fell down the crypto rabbit hole and the work that you are doing today. June, let's start with you.
My name's June, and I am co-founder and president of Figure Technologies. And we started the company to explore blockchain to create efficiencies in the financial industry. And we started with securitizations. And I'm happy to say that we just did a rated securitization, a AAA rated securitization that priced 25 bips under JP Morgan's transaction that happened at the same time with the same credit. So that's the first time that you have a premium on a blockchain transaction rather than a discount.
Nice.
It is a pioneering transaction. Congrats.
I can say more, but
We can go down the panel.
I'm looking forward to when we don't have to say when we fell down the crypto rabbit hole, which I predict will be in the next year. But my journey was at Citi. I was at Citi for 18 years around the world in various senior operating jobs, and implemented blockchain twice, once with NASDAQ in 1617, and once with Alibaba and Ant in 1920. So along with Christina, a bank practitioner, cut our teeth on blockchain. But I'm CEO of Provenance Blockchain Foundation. We are purpose-built to support regulated financial institutions with over $8 billion of total locked value of real-world financial assets on chain, and helping financial services participants serve their customers better.
Good afternoon, I'm 𝐲𝐮𝐬𝐜𝐫𝐢𝐻. I'm the co-founder of NovaWulf. I first looked at blockchains in 2015, 2016. I was at Blackstone for about 15 years, running the distressed business there, and as part of that, really looked at blockchain efficiencies that could be brought into financial services. It was pretty amazing to me, having traded bonds for 20 plus years and loans, that I still had to pick up the phone and it would take 2+ weeks in some instances to settle. So I thought there's got to be a better way. So looked at blockchain, and then that led me into Bitcoin, made some personal investments. I had done a lot in the power space, which then also led me into Bitcoin mining, which I view as sort of a power infrastructure play into crypto. So that was sort of my evolution. And then about a little over a year and a half ago, decided to launch a firm with a few partners focused on digital assets, generally speaking. We'll talk more about this, but bringing kind of real-world assets onto crypto rails, and thought that there could be an opportunity to sort of be the capital provider in that context. And then the market fell into some areas of distress, so we've pivoted our focus a little bit more, given our backgrounds in distress, to look at what's happening in that part of the marketplace as well.
Hello, everybody. I'm Christine Moy. I'm a partner at Apollo Global Management. We are a $500 billion asset manager that is focused on credit, private equity, retirement services, and now digital assets. In the digital asset space, we are investing in the ecosystem, in companies, and in protocols. And we are also leveraging the technology. So incubating use cases and actually figuring out how blockchain technology will be a key part of asset management infrastructure in the future. I got my start maybe 7 years ago at JP Morgan. I built and led JP Morgan's blockchain program. While there, did a ton of different things, but tokenized the dollar, so invented JP Morgan coin, just 24/7, 365 US dollar payments on blockchain, tokenized bonds, tokenized treasuries, tokenized renewable energy certificates, tokenized vehicles, even tested tokenized payments in space, in the lower Earth orbit between multiple satellites. And so really have spent most of the latter part of my career thinking about how tokenization will improve financial services and create more optimized products.
And I'm looking at the title of the panel here on the new narrative for crypto. And Morgan, maybe I'll pose this question for you, because there have been a lot of clouds, especially post-FTX and other failures. I was hoping you could speak to how far that may have set us back and what the new narrative going forward looks like.
Yeah, I mean, I think with FTX, it was the end of innocence in crypto, and we're starting to turn the page to a more enduring chapter, right? No longer crypto token trading as the focus and taking up all the oxygen and energy, but really turning to how do we use decentralized platforms, issue digital assets to transform businesses. Our view is in financial services, that impact is material. It disintermediates a range of costs and time. And so I think this is we're starting the more enduring chapter. 2022 was the first year of true institutional adoption by leading firms, several of which are on the stage today, in core business use cases. This is no longer POC, this is no longer fringe use cases. So we've begun the next chapter, and it is getting to $1 trillion plus, and we'll get into the various use cases that are live and coming soon.
Yeah, it might be helpful too to like level set, just defining tokenization. June, do you want to take that one? Just defining it for, I'm sure a lot of folks are aware of it, but just, to level set here.
Yeah, the way that we look at it is it's a true digital asset, meaning that there's no other way to trade it or sell it or buy it unless it's on the platform. And if you do offline, then it's not a valid transaction. So we always talk about truth versus trust. The blockchain, when you have your asset on the blockchain, you have the truth and you have the provenance of that asset, right? Like chain of evidence of where that asset has been, who owns it, who used to own it, and who owns it today. So you'll never have a question about who owns which asset, which we all know some of that happened in 2008.
Yeah. And when we talk about a $1 trillion opportunity, I guess for the panel, in your view, from where you all sit, how do you get there? What is the pathway to the $1 trillion opportunity? Maybe we can start with you, Christine.
Yeah, sure. I mean, I think that we're well on our way. One of the use cases that I developed at JP Morgan, which I'm most proud of, is from my time there, was that we tokenized treasuries and US dollars to enable the ability to have basically do an intraday repo trade. Essentially have a repo trade that was counted in minutes as opposed to days. So like open a trade at like 9 a.m. and close it at like 9:05 if you wanted to. You wouldn't need to, but within the day. Creating a completely new experience, a new financial experience, and using smart contracts to coordinate both the US dollar leg and the tokenized treasuries leg. Since I've taken that live, and we took it live during the COVID year, JP Morgan has recently announced, I believe like a few weeks ago, that it's already transacted $700 billion of tokenized treasuries in US dollars with just a few counterparties like Goldman Sachs and BNP and just a couple other banks and broker-dealers that have been announced. So I think that's an example of how we are well on our way to $1 trillion and $1 trillion more.
Yeah, I would just add that I think ultimately a lot of success is going to be defined here when it's not even really noticed where things are trading and it's sort of taken for granted that the asset is tokenized because that drives the most efficiency. So, look, I think you've got massive markets that are going to migrate on-chain. We'll probably talk more about the regulatory framework that's required to get there. But I think, it's going to be when this is sort of the underpinning of the financial system and, the fact that assets are tokenized is almost just a foregone conclusion. And I think that's going to happen sooner than people think, particularly coming out of the ashes of all sort of the froth and excess that have been happening for the past, few years leading into, FTX and the other distress situations.
And the reason why we are at this inflection point now is because, whilst, for example, I mentioned I'd been working in digital assets for about 7 years, and so have a number of these participants here on the panel, like for each step, we had to build block by block or piece by piece the main components of how to create this financial infrastructure. Like, for example, I remember when we first tokenized a bond back in 2017, it was like, how do we settle this? We need to have US dollars represented on a blockchain registry. And then there were things like, okay, well, how do we actually make sure that we know how to run this technology securely within enterprises? How do we get all of our compliance, risk, and cybersecurity teams on board and comfortable with this technology? Now, many years later, a number of traditional financial institutions have done that work, have done a lot of experimentations and proof of concepts and have a deeper understanding of this technology than they have before. And that's why, for example, as Jason mentioned, we're sort of entering this phase where, in reality, the technology should fade into the background. Like, I don't think anyone ever leads with like, I'm building a business that's like based on AWS, or like, I'm building an email-based business, like, congratulations. Like, at some point, it enables the business and it's efficient and it makes us, it enables us the ability to do more with more people around the world faster. And similarly, a digital assets infrastructure and blockchain will enable that in the context of value transfer and transactioning.
Maybe just to add there, I think if we think about the layers of the financial cake and how the new cake's going to bake, we've matured a lot in terms of the layers. So digital assets, right? Provenance has the ability to create assets with smart tokenization that has embedded ways to control that asset, data privacy off-chain, et cetera. Digital money, that's coming, it's evolving, coming soon. We have digital custody and security. That continues to evolve. Digital identity continues to evolve, and networks and chains continue to evolve. So think of those as the pieces that are maturing to help create products and solutions that are much more easily plug-inable by asset issuers and asset buyers. If we think about the opportunity, how we get to beyond the 1 trillion, I would start with private asset space is a $290 trillion market around the world. That's bigger than publicly traded securities. That's things like real estate, private equity, VC. And that's, in our view, one of the killer apps for blockchain, because these are operationally intensive assets to issue and manage. They're non-price discoverable, non-transferable, tradable. And when you put those assets natively on chain, you begin to create more liquidity, more tokenization and fractionalization, broader access and availability of those assets.
Would you like?
Do you want to add? Yeah.
We always look for real world use cases because we're always looking to prove the efficacy of the system. And so what we're thinking about today is that the GSEs are pulling back and really wanting to be more inclusive and focus on inclusive loans, which opens up a huge opportunity for the private capital markets. And so we're working with firms like Apollo and 6th Street to create an ABS mortgage marketplace. And so those are the types of things that really pique the interest of firms that we talk to just think about, not only our own businesses, but their businesses and how they can bring it in and create a more transparent marketplace for anybody to buy the assets and sell.
So we were talking about we're at an inflection point right now. What does successful adoption look like to you? And maybe if you focus that on like financial services, when will that be apparent that we're starting to see successful adoption? Do you want to take that one?
Me?
Yeah.
I think it's, as Jason and Christine were saying, we don't talk about blockchain anymore. We don't talk about the infrastructure anymore. We just talk about, what the asset is, bringing the asset on, what value you're trying to create and increase in the system, and how you want to trade it, rather than, okay, let's talk about the asset on the blockchain. Do we want to look at the wallet and go onto the Explorer and take a look? I mean, so it's less of a conversation about the infrastructure.
Yeah.
Yeah, and I think focusing, this is for customer and business relevance. So, Figure's doing 5-minute HELOCs, home equity lines of credit, and a digital WOW process, money in your bank account in 5 days. And it's only 5 days because the regulations require the customer to think about it. So that you can start creating digital WOW experiences that create in the lending space, for instance, 150 basis points plus improvement from the mortgage origination to the servicing, financing, and securitization. And that number is even higher given the rise in interest rates. So that means you can provide a lower interest rate to the customer, and the mortgage originator can basically earn a higher net margin. So we are focused on delivering real value in terms of the use cases, and each asset class has different parameters. So with lending, you're tying the credit file in a bow to ensure the credit file hasn't changed. You get real-time information about payment status of all the loan portfolio, as an example, that a buyer of those assets can then look at in real time and decide, or do this rated securitization more programmatically. So you can programatize the distribution of lending assets, as an example, just to give some real world value use cases.
Yeah.
I think just to build on that point, I think ultimately you're going to define success when the financial efficiencies that are built in blockchain result in lower cost to issuers of financial product. And I think that's really the key. I think there's going to be a period of time because of a lack of familiarity by the buy side where you're going to earn excess returns because people are like, I don't really know about this where it's listed. But as both Morgan and June mentioned, they've already seen an instance in which they've priced a comparable issue in tight to something that was not priced on blockchain. And I think as things evolve, those efficiencies are going to ultimately be shared by the buy side and issuers. And I don't think this is decades off. I think this is years off. And I think we're going to start to see it accelerate, particularly with a tighter regulatory framework.
Speaking of the regulatory framework, from where you all sit, what do you think needs to be done from the regulatory side, perhaps even more of the legal side of things? And to go with that, like, how do you balance the regulatory side of things without hindering innovation from where you all sit?
I might jump in on, in my view, we have real world assets, financial assets on chain successfully, which is really exciting. We need the regulated digital money on chain as well for this whole thing, for the flywheel to really deliver the better outcomes that Jason talked about. So for instance, the USDF consortium CEO, Rob Morgan, is testifying tomorrow, and USDF is bank minted tokenized deposits. But you need banks to be able to ultimately participate on blockchain. Right now, that's quite difficult in the US, for example, on public chains. And banks hold 70% of the money in their vaults. And so I think we do need digital money on chain, because then you get to the true automation of finance, because each financial asset either gives off cash flows or requests cash flows, and then you get this true digitization of digital asset lifecycle.
Talking to the regulators is really about education. You're really trying to educate them to understand and kind of bring them up to speed on what you're thinking about and why you're thinking about doing it that way. We do everything under the regulatory umbrella, and sometimes it is a drain because you got the compliance and legal teams saying, "Hey, don't do that." But I think that they really need to start thinking in a way that allows for creating efficiencies and transactions for the institutions, so that everyone can be more efficient in the world, and it just all moves along in a better way.
Yeah, I think as the regulators learn more and understand the efficiencies that are being brought, there are some things that the blockchain accomplishes that, there's redundancy in traditional finance, like a transfer agent, for example, in an equity trade. The blockchain effectively does that. But in order to trade an equity, you need a regulated transfer agent. So therefore, rather than fighting that issue, I think both June and Morgan have taken this approach. It's educate the regulators that, hey, this efficiency is there, the blockchain acts in that capacity, but I want your permission to actually utilize that in that way, as opposed to fighting. And I think a lot of people within crypto have, sort of taken the opposite approach, which is regulations don't apply, therefore I'm not going to try to comply, and I'm just going to fight if I have to. And I think that's not the right approach. I think the right approach is education and then ultimately adoption. And that's where I think as you see more traditional finance make their way into blockchains, I think that'll be the approach that it's adopted. And that's going to allow it to scale.
Digital custody is another big one. Again, as more institutions come and buy assets on chain natively, many of them are not going to want to self-custody them. They want custody options. And so maturing the custody offering and regulatory framework, I think, is also an important building block.
Anyone want to add anything before we move on? What I was listening to you all talking about efficiencies and cost saving, and I know Apollo and I know NovaWulf, you all have done some firsts and been pioneering. I was hoping maybe we could speak to some of that work in particular, some of the first that you all have done.
And Figure.
Sure.
Figure as well.
You start.
Okay, I'll start. So we've gotten involved, and this is all public, in the Celsius bankruptcy, and our proposal there would be, as that company emerges from Chapter 11, working with a lot of the folks on this stage to actually have the first truly natively issued equity on a blockchain. So this is not a digital representation of an equity that's essentially listed elsewhere. This is an equity that's basically created and traded on a blockchain natively. And there's some things in the bankruptcy process that allow us, we think, to get there faster. And I think that really could, hopefully, people look back at this as a seminal event where you actually have an equity that's traded, it's registered, it's a public security, but it's traded on blockchain and can be traded peer-to-peer, eliminating multiple rent takers in the process.
What do you think that could look like at scale?
My view would be, I don't see any reason why, just like, Intel took the leap of faith of listing on the NASDAQ, I think in like the early 1970s, you'll see more and more companies actually listing their equities directly on a blockchain and then allowing peer-to-peer 24/7 trading on a global basis, without the need of, a prime broker and a bunch of other intermediaries. And obviously you have to do it on a registered exchange, but you need to build that infrastructure to further facilitate it. But I think we'll look back in several years and people will be trading equities peer-to-peer on their telephone.
And I think we're also seeing there on the private securities side that we have a range of private securities on chain today. And that enables secondary liquidity opportunities to be opened up for trading, right? Opening up for employees to trade or get liquidity, right? If they're working at a young company kind of thing. So that's already live on Provenance as an example through Figure Equity Solutions.
Yeah, let's talk about some of the pioneering work that you all have done at Figure.
What work?
Well, we're talking about some of the first. We were just talking about doing the Celsius bankruptcy and making that an equity traded on the blockchain. What are some of the first that you all are doing at Figure?
I think a lot of what we do, or most of, or all of what we do, are firsts. We put the entire loan onto the blockchain, and we sell them, and we run participations, and we create securitizations. We issue securitizations. So a lot of what we do are firsts. On the fund side, as Morgan was saying, we put the fund on for the subscription process for closed-end and open-ended funds. We built capital calls, and so a lot of these things, we think about real-time settlement, and so everything we do is all around real-time settlement, and that's sometimes where regulators just get kind of tripped up because they don't really understand. They're like, what do you mean? There's got to be somebody else that actually settles the trade. And we're like, well, not really, it doesn't have to be. So in some cases, we kind of have to play along while they get up to speed on what it is we're doing and why we talk about real-time settlement.
Wait, why do you think they get hung up on that?
I think that a lot of times the regulators have been doing the same thing for, 50 years. And so they have a really hard time changing the way they think about it because they're too worried about how it might go wrong.
And just to add on how we think tokenization may impact the private markets and alternatives. Apollo has spent a lot of time with these team members, actually purchasing actual live mortgages off the blockchain, which is really, really cool, like to have real-time servicing reports and monitor your assets in a portfolio. You can only imagine sort of how that builds up when you're talking about a securitization. Additionally, we've tokenized our private funds as well. Now, I think the asset management industry is kind of at this stage where it's like, hooray, like I've tokenized something, like now what? Which is actually where banks were quite a few years ago. At least like what I'm gunning for and what I'm working towards is obviously trying to change the world for the better. And, the North Star that I have as it relates to tokenizing private funds is that I think tokenization can be a normalization layer to basically make private assets, alternative assets, as operationally fluid as, say, equities, ETFs, mutual funds. Now, why does that matter? Today, in basically the wealth management industry, we can say that now we're kind of in this asset gathering type of phase where private banks and RIAs will design a model portfolio, and for every incremental dollar that comes into this RIA or private bank, each part of that dollar gets allocated to some pie chart that their CIO have designed. Now that pie chart is usually equities, ETFs, mutual funds, all the easily automatically rebalanced asset types, but never really the alternatives. The alternatives are always off to the side, sold separately because you have different investor accreditation requirements, but more significantly, the operational processes and the liquidity of these asset types are completely different. And so I think that there's a really interesting opportunity where tokenization can almost put alternatives on an even playing field with these other asset types, so that when CIOs are designing these model portfolios, they can actually include alternatives in these automatically rebalanced, kind of allocations. And what that means for asset management at large is that for every incremental dollar that goes through a wealth channel, some part of that dollar will be allocated to alternatives, which means for those of us that create alternatives, that's more clay that we can, sort of work with and provide value to investors with in a more streamlined, automated way than how it's currently being delivered. So we think that that's going to be a huge paradigm shift for the alternatives industry if we're able to and when we're able to sort of crack that nut of using tokenization to normalize alts.
Yeah, as you put it, a huge paradigm shift, and I like that you said it was your North Star. For my fellow panelists, what will be the North Star for you all, or kind of that moonshot, if you will, from where you sit?
Well, if we fast forward a decade, my humble belief is a majority of financial assets will have been issued natively as digital assets on a blockchain, traded on a blockchain. That is hugely disruptive to how financial services works today, which is via permissioned intermediaries. And I think public blockchains offer the opportunity to catalyze greater innovation in the space than we've seen to date. And this is finance's internet moment, right? This is when the financial architecture changes materially. It's having been in financial services for a long time now, it really is the most significant development in terms of lowering the cost to serve, ultimately providing broader access to a range of particularly alternative products, and opening up more access and innovation. So when we fast forward, we're building the bridge across Death Valley right now, slat by slat, asset class by asset class, use case by use case, with the coalition of the willing and able. And we are going to get there, and it'll be a lot more efficient in finance.
I think for us, well, for me, maybe personally, I think about technology as really a way, like a true way to create efficiency. And I think that, when somebody says digitize, right, they might take a document and turn it into a PDF. Okay. So if you think about, we have a cap table management business where there's companies that want to raise primaries or secondaries. You can do it on the platform. And the thing about that is when I got into it, as a startup and maybe as a regular large company, I haven't done that. You're issued stock or you're issued options, and when you buy the stock, you have this certificate number. And if you end up selling, 50 shares of a 100-share certificate, they issue another certificate number, because that's what they did when you used paper, right? You had $100 and it was actually on a piece of paper, and if you sold 50, they ripped that up and created another piece of paper. Well, that's what the data management systems do today. So I'm like, well, why would you do it that way? Well, it's digitized. There's a transaction that happened, and so now it's not 100, it's 50. So for me, it's really, looking at technology as something that can help. And it's not supposed to be the crypto, we don't want to talk to regulators type thing, but it's really, let's create efficiencies in this market. Let's create transparency in this market. As Christine was saying for alts, there's always a dialing for dollars thing to find buyers, or you only have 3 buyers. And so, it does open up and democratize that industry for other qualified investors.
Well, I think I'm not going to repeat what everybody's just said because I think I view the world very similarly. I just think you're going to have a lot broader adoption, and I think hopefully, to Christine's point, a lot of people are boxed out because they're not qualified purchasers or QIBs for participating in perceived to be higher risk investments and alternatives. And I think as you have more fractionalization and better liquidity in those products, I think you may see the regulators get more comfortable with more mass adoption and distribution, because I think the perception of risk and the reality of risk are not necessarily the same. And I think, but the challenge is right now, you have money in Apollo fund, the secondary market is just not going to be that liquid for that. But if you have more liquidity in 3, 4, 5 years down the road, I think that's going to really help broaden adoption for the alternative marketplace broadly, which I think is a really good thing.
Besides the regulatory side of things, what else do you think is holding back the speed of adoption, if you will? Are there other factors that are holding it back, or is it mostly regulatory?
I think there's a little bit of just a lack of knowledge and fear. I think as it relates to, holding your own keys, for example, running your own servers, there's not probably a lot of people in this room who want to hold their own keys or run their own servers. But I think, we're going to move past that point where there's going to be regulated institutions that facilitate that. And so I think you need to sort of further develop the infrastructure in a regulatory compliant way and make it easy for people to transact. And we're headed there quickly.
Yeah, it's also that a lot of institutions already have systems, right? And so they're like, oh, a new one? Like, how do I bake that in? How do I decide and tell my customers will move from the system to that? I mean, like JP Morgan has systems they've been running for, years and years and years, and they make a lot of money off of them. So why would they mess with it, right? So it's that kind of adoption that's difficult because it's like inertia, right? So I think that's part of the issue, but I do believe, and I think everybody here believes, that we are at a turning point and people are starting to understand and they're really leaning in and thinking about, okay, what's my first use case? What can I actually do here?
I also think, the UI UX in general of blockchain needs to keep developing, right? So meaning, even wallets, account abstraction, so you don't have to have 12 seed phrases on a piece of paper that gets wet kind of thing, or more developer tooling so it's easier for people to build capabilities. We need to keep productizing the chain, like Figure has done as an example, and NovaWulf is building to basically allow other people to plug in to their services that is in this nice digital package. So a lot of our pipeline that we see today is a funds format, no matter the underlying asset, the financial asset. And so we need more fund sort of capability shrink wrapped on chain so that it's easy for folks to launch fund. And Figure has really pioneered with their digital fund service product. But that's the vehicle that a lot of the tokenization is happening.
I also want to add that I think that the speed of innovation and technology development is actually in this domain, especially across these partners, is flying. Having been at a bank for 20 years, any major infrastructure project is multiple millions of dollars and multiple years to no end, most likely. And those of you that have, kind of been in these projects, And what we're really talking about here is shared infrastructure. Like, it's not even like infrastructure for one firm. It's like infrastructure for multiple firms. Enterprise-grade infrastructure for multiple highly regulated firms. So I would say, in terms of the progress that I've seen to date from Figure and Provenance, like, we are flying. If we're measuring against, what is actually, kind of like high quality, good for real value transfer at scale across multiple regulated institutions. And so, as with all things, it takes time. And, furthermore, like, whilst the crypto asset class is kind of having like its winter moments, and, there certainly have been a lot of mistakes happening in that industry, I think the key thing to note here is that the technology that was spawned from all of that wild experimentation and investment is here to stay. I don't know. I haven't been around that long, but I've been around long enough to know that technology never really goes back in the box. Once it's out of the box, it just keeps progressing and evolving, and it eventually becomes an integral part of our lives. And so likewise, as it relates to shared ledgers, digital assets, blockchain, like this is not going back in the box. It doesn't matter what how long this crypto winter is, this technology is out in the world. People have invested an enormous amount of money and time and talent into it. It's just gonna get better. And really what we're kind of gunning for is that it gets so good that it becomes invisible, no one talks about it anymore. I mean, it'll be bad for us because then we won't get to see you guys on stage anymore because it'll be like blockchain, womp, 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 super boring, like let's not talk about it on stage because everyone's just using it like email or like websites or mobile apps as an example.
Well, and to that point, I guess last question for the panel, and we'll go down the panel, start with you, June. In the next few years, I hear we're a few years away. Let's call it 5 years. What does the world of finance look like from where you sit?
5 years. Well, hopefully let's call it 20% of the world's assets are tokenized.
I'll say I'm into that. I would buy that one. I would also say regulated digital money is broadly available, fiat-linked, issued by regulated participants in some regulatory framework. That will be a lot more ubiquitous in my view. We'll have a much greater asset tokenization and value delivered on blockchain. And better UI UX, as I talked about. I think you'll have great tooling. You'll be able to plug in more easily. Right now, it's a really walk before you run kind of technology. And it is decentralized in the sense of it's collaborative, as Christine very capably said. So I think a lot of the tooling will be much better to harness the tech. It'll be API plugins is how anybody in this room will be using blockchain.
I would agree with all that. I think that this is not a circumstance in which large financial institutions who are arguably earning excess rents right now are saying, oh, that's never going to take away my margin. Everybody's aware. Everybody's aware it's coming, and they're preparing for that inflection point where it's all of a sudden, okay, I have to pivot, I have to give up that, but I'm gonna build efficiency. This is not gonna be where people, I don't think, maybe some are gonna be asleep at the switch, but I think for the most part, people know this is coming, it's gonna change their business models, but it's gonna make them more efficient, so it's one of these, low revenue, higher margin opportunities, and it's just, as soon as it starts to happen, I think it's going to be, issuers who drive it for financial products, and I think that's going to happen in the next couple of years.
You guys already know my vision. Alternatives and automatically rebalanced model portfolios, democratize access to alternative and private assets, and maybe I was going to say portfolios designed by these CIOs that are probably going to be AI or machine learning driven. Just to sprinkle some other emerging tech buzzwords in there.
There you go.
And put all of us out of a job.
Yeah, exactly. Everything will be automated.
There you go.
Well, and also that regulators kind of understand what's happening. It's not a bad thing.
I think that's a great way to end. Well, I want to say thank you so much, June, Morgan, Jason, and Christine. Thank you so much for being so generous with your time and your ideas and helping all of us learn more. Thank you so much.